My name is Ian Squires, and this is my Bloomberg-based project for Finance 551 in the summer of 2018. So the objective of this project is to analyze three industries. Um, so I chose newspapers, construction, and restaurants. I currently work at the school newspaper, and I wanted to learn a little bit more about what's going on in the industry and kind of see where it's headed and kind of like learn from it. I picked construction because it was kind of something that I'm not really familiar to that I wanted to learn some more about, and restaurants because I used to be a chef and I wanted to see what's going on in the industry and learn a little bit about it. So I'm going to analyze these companies based off of five categories: short-term solvency, long-term solvency, asset management, profitability, and ROE decomposition and market value. And also include some supply chain stuff and news as where it's applicable and where there was like some interesting things. So for the newspaper industry, I chose these five companies: the New York Times, the New Media Investment Group, Lee Enterprises, A.H. Bello Corp., and Gannett Co. New York Times does newspapers, and they also do digital advertising on their website. New Media Investment Group, they do a lot of like niche publications and like a lot of online stuff, kind of like both at the same time. Lee Enterprise, the same thing. They do almost the same thing as New Media Investment Group. H. Bello, they do just straight newspapers, and they have some holdings in other newspapers. And Gannett Co. does some niche publications and like Yellow Pages and stuff like that. So for the current ratio, it seems everybody's still around like the same ballpark. In 2013, New York Times had a pretty interesting year, which we'll see further along as we get through the ratios. But over time, we can see that their current ratios are kind of like fluctuating, like especially New York Times going through 2013, 14, 15, 16. It's kind of going up and down. And so this kind of shows that, something's going on with their cash, their receivables, and stuff like that. We see that Lee is pretty consistent, kind of going across the board. They have the lowest numbers, and they're pretty much around the same. They didn't fluctuate as much as New York Times. So that's an interesting thing that's happening as the industry's kind of like when they're all very similar and everybody's kind of moving up and down, but Lee's staying pretty consistent. And then the quick ratio, once again, the New York Times has the highest number in 2013. That was quite an interesting year for them. And then back to normal numbers straight after that for the New York Times. And then Lee, once again, very consistent throughout. Not much seems to change with them. And then AHC is they're kind of fluctuating just between this very small margin here. And GCI was also a little bit consistent between 2013 and 2015, but they kind of dropped right here in 2016. So that shows that something happened with their receivables that like really changed. In the cash ratio, once again, Lee is very, very consistent, 0.16 through 11. And then New York Times very high again in 2013, and then back to consistency. And then New Media, these guys are fluctuating up and down. In 2015, they kind of stay around the same. So it's kind of interesting what's really going on in the industry. Basically, what happened was for the newspapers, and starting in 2001, there's been this cliff of advertising revenue, and it's just gone down very much. And so to make up for that loss in advertising revenue, what they've done is they've moved to digital platforms. And the weird thing about digital platforms is that when people visit the websites, they'll see the ads and it'll drive traffic, but it's not always necessarily translating into sales. And sometimes ads online can be very aggravating. And it's really interesting what's happening in the newspaper industry because their biggest thing was their advertising revenue. And the advertising revenue for digital has not been able to like provide them the revenue that they used to have through the print advertising. And print advertising was very effective and gave them a lot of cash flows up until about 2001. And right around 2001 was when some interesting things started happening with technology and people started getting on computers more, and information became a lot more widely available. And people began, this is like right after the dot-com bubble burst. And then after that, it was all straight downhill. But the interesting thing about that, though, is that niche publications are still thriving and they're doing very well and still providing good return on investment for their advertisers. And those are still good sources of income. But as far as the equity multiplier, Lee didn't have any data to pull from. And that was something interesting. I think that was an error in Bloomberg because I don't see how that could happen unless they didn't have any liabilities, which I have to go double check. But New York Times has stayed pretty consistent between 2013 and 2015, and they kind of dropped down in 2016. 2016 was a pretty hard year for the newspapers, and we can see that New Media didn't have anything in 2013 as well, or GCI, which is kind of odd. I don't think that they would just not have loans one year and then next year they would have loans. And I pulled the data the exact same way that I did off of Bloomberg, so I'm not quite sure why that would happen. But AHC has stayed pretty consistent throughout their years. And then the time and interest earned ratio. This shows how many times that you can pay your interest. So New York Times was doing very well in 2013, and then it kind of dropped down here in 2014, came back up in 2015, even better than before, and then dropped back down, and then came back up even better. So there's a lot of fluctuations with New York Times, while everybody else is kind of consistent in the industry. Once again, the AHC didn't have any data here. This is the total asset turnover ratio, and overall, we can see that everybody seems to be within this range of about 0.62, 0.59 at the lowest to 1.16 at the highest. And it looks like GCI doesn't have any data that was pulled from Bloomberg in 2013, which is kind of odd because that means they didn't have sales or they didn't have assets. So I feel like, once again, that's an error in Bloomberg. This is the only industry that I had problems with pulling data from Bloomberg. But this is one where New York Times was pretty consistent, and it shows that their sales have been kind of consistent throughout. The profit margins. This one is pretty interesting because we can see that New York Times has fluctuates between about the same range, and everybody's almost around that same range. But New Media right here in 2013 had this insane profit margin of 153.84, which was really interesting. And I couldn't exactly narrow down from the financial statements exactly why they had this insane profit margin. And it looked like they just had a lot of sales that year. It seems like 2013 might have been a really good year for the papers, and then 2016 was extremely rough. You can see that AHC in 2016 had losses. They had a negative profit margin, so their costs were extremely high. And the return on assets, New Media right here with 137, which is absolutely insane. And everybody else is floating around this like 2 to 5, and then AHC comes out of nowhere with this 32.16 in 2014, which is kind of odd. So, and return on equity. So AHC's been kind of odd here because it's really high in 2014, and in 2015 it just dipped twice really hard, and it makes me wonder what really happened in 2014 that made it so abnormal, and then it came back down. And then once again, the New York Times was very consistent. So it's really showing that this industry is very volatile because most of these guys don't do just newspapers. They also do broadcasting, and they're very subject to government like laws and stuff concerning the FCC for the things that they can broadcast and put out there. So, but tax burden. All right, New M has and a really high tax burden in 2014, and it's just really, really high, just consistently. Um, and it's almost around the industry average seems to be about 60 to 90, but these guys are really high, and AHC has 461 in 2013, so that's really huge. Interest burden. For some reason, it seems like GCI might not have had any loans in 2013, 14, and 15. And New M they didn't seem to pay very much interest in 2013. And 2014 seems like they might have paid a lot. But the EBIT margin, once again, New M in 2013 has this insane EBIT margin, and then everything else is kind of normal, with the exception of Lee coming out in 2016 with this 19.93 EBIT margin, which is extremely high compared to everybody else. PE ratio. So PE ratio, this shows how much someone is willing to pay for $1 in earnings. So in 2013, someone was willing to pay $34 for $1 in earnings for a New York Times stock. So the PE ratios are pretty high. They're doing pretty good. And some might even call them overpriced. So they're doing healthy. They're staying strategic and keeping alive, even though things are volatile, especially with the newspaper industry, with regulation, with the FCC and things like that. So they're doing pretty good. And AHC was extremely, extremely high in 2013, and then it drops down to 16 in 2014. And here's the market to book ratio. So this shows that the New York Times in 2013 was worth 2 times what it said on its books. And everybody is worth almost as much, or if not more, at least what their book equity was worth. Economic value added. For some reason, some of these numbers came out negative, but their economic value spread was positive. So this was kind of an oddity. I think this might have been some Bloomberg error, but I'm not 100% sure. It was very hard to go back through the years, for every single company while doing the project to really find out what exactly was going on. But Lee has been doing the best out of all these guys, and the New York Times, it doesn't seem to be making as much as investors think that they are, so which might further indicate that the stock is overpriced. So that's it for newspapers, and now we're on to construction. So I chose 5 companies: ACOM, Jacobs Engineering Group, KBR, Mastech, and Primoris Services Corp. Most of these guys do commercial construction. A lot of them do stuff for governments, so they'll build things like interstates. So they were pretty much homogenous between the things that they did. Their current ratios, and we see pretty much an average between 1.5 and 2. They're very consistent over the years. They don't change too much, so we don't see too many changes happening. Their quick ratio, pretty much the same thing, pretty consistent, nothing really alarming here. Cash ratio, as you can see, they have a lot more in receivables and inventory than they do in cash. And so MTZ doesn't keep very much cash, as we can see. The next one is the equity multiplier, and things pretty consistent. Once again, there's no big major fluctuations like the newspaper industry. It's kind of pretty consistent. These guys are just kind of plugging and chugging. They're doing pretty good. Times interest earned. KBR actually didn't have any liabilities from 2016. They were financed mostly through equity up until 2017. And MTZ, total asset turnover. there's nothing really too big here. We kind of have like 1.4 up to like 1.96, and then like 1.13 at the lowest. Nothing too big. But it looks like these guys are all pretty healthy. They're doing very good. Profit margins. So these guys have some pretty good profit margins, and they're very consistent. KBR had a pretty bad year in 2014. There seems like their costs may have gone really up. Um, Other than that, everything seems pretty healthy. They're all doing really good. Return on assets, they're doing pretty awesome. Once again, KBR had not a very good year in 2014, and things are going pretty steady. Not too much is changing, but ACM did drop their profit margin in 2016, which is not as good as their peers. MTZ did the best in 2016. Return on equity. So once again, KBR had that one bad year, and I bet the shareholders were not happy with him. And other than that, things are pretty healthy. Tax burden. Everybody seems to be paying pretty much around the same taxes. KBR, it looks like they might have had some net operating loss carry forwards in 2016. And that's why that tax burden is negative. Interest burden, once again, KBR did not have any loans up until 2016. They were financed only through equity. EBIT margin, I'm not quite sure why this one came out for blank for KBR. That might be a Bloomberg error. Maybe it didn't pull the number that KBR reported in their financials. So everything's pretty consistent throughout the industry here. The PE ratio, KBR was really overpriced in 2013, and then there's no data in 2014, which is kind of odd, and I'm not 100% sure why they didn't have a PE ratio. So I might have to dig and see why that happened. But overall, these guys, they usually say that anything 15 and over is overpriced, and almost all these guys are pretty much overpriced, with the exception of KBR in 2017. Market to book. These guys are doing really well. Almost all of them are, throughout the years, have been almost double what the book equity is. So these guys are very healthy. Economic value added. A lot of these guys are negative. They didn't earn as much as they thought that they would. Especially KBR in 2014. They did not do too well. Looks like they lost like $1 billion. So MTZ, they're doing pretty good, and they had some pretty good returns in 2014. And now we're on to the last industry, which is restaurants. So I chose Darden Restaurants. They do everything from Red Lobster to Applebee's, Chili's, Olive Garden, pretty much any restaurant that's kind of like that. Cheesecake Factory, they're all over America. BJ's Restaurants, they're only in a few states. So they're in California, Nevada, Texas, and kind of like in the Southwest area. It might not have been exactly fair for me to compare them to, national restaurants like Darden and Cheesecake Factory, Texas Roadhouse, and Cracker Barrel. But I think, given the strength of their financials, it's good to compare them, because Bloomberg also Bloomberg listed them along as their competitors. So I think that they're a pretty good fit to compare against. Texas Roadhouse, they're all over America as well. These are all non-franchised companies that are owned by the corporations. Cracker Barrel, Old Country Store. These guys are located primarily in the South. They're headquartered in Tennessee. So we kind of got like a little spread all across America for these restaurants. And the restaurant industry, the current ratio, we can see that this is very low compared to the other industries. But if you really think about it, they don't really have that much receivables because most of their sales are in cash. And the quick ratio, it's even lower. So that shows, once again, the receivables. And the cash ratio, these are actually kind of low as well. So it shows that they're really just taking that money and just kind of like plowing it back into things, paying their bills. Um, the equity multiplier. So this kind of shows that everybody's pretty much consistent. They all have around the same range. Darden Restaurants has the highest equity multiplier in 2013 and 2014. And then at the lowest, we have Texas Roadhouse at 1.50. And they stay very consistent about that. The times interest earned ratio, not 100% sure why BJRI and Texas Roadhouse didn't pull this, and I think maybe they reported this on their financials as something different than what Bloomberg was pulling. Maybe they called it like debt or like a convertible bond or something like that, and like maybe it was only pulling, liabilities. I'm not sure exactly, but Cake, they're doing very good. They can pay their interest over like 1 billion times. It's awesome. Darden, they didn't make that much to where they can pay their times interest earned as much as Cake, but they're still doing pretty spiffy. And Cracker Barrel is just doing pretty good, consistent job. Total asset turnover. So Darden didn't do as well in 2013 and 2014. In 15 to 16, they're doing a pretty good job. They're having more sales than they have assets. And Cake is very consistent, pretty high. That's really awesome to have almost 2 times the sales of what you have in assets. And BJ, very consistent. Texas Roadhouse is doing interstellar as far as their sales to assets is concerned. And then Cracker Barrel is leading the pack with almost 1.9 times the sales that they have in assets. So profit margins. So these guys this is pretty interesting because their profit margins fluctuate. So the restaurant industry is very dependent on the traffic that they get into the restaurant, and lately the traffic has been going down a lot. So this has really been hurting their profit margin. And the reason why traffic has been coming down in the restaurant industry is because of softening consumer budgets. So people haven't had as much money to go out to eat and stuff all the time. So they've been trying to find interesting ways to make sure that people have that experience when they come in to eat. And so their profit margins are going up and down depending on sales, and there's this definite relationship between the two. So, oops. But Darden has the highest profit margin in 2015. They were outperforming all of their peers, and I'm not 100% sure exactly why that profit margin was that high, almost double all their peers. But other than that, everybody's been very consistent between 5 and 6. But it's been jumping up and down because of traffic. Return on assets. So let's see. Cake did really good in 2013 compared to all their peers. Cracker Barrel's very consistent, very high. They don't fluctuate as much, and the reason why is Cracker Barrel, they have this gift shop in the front of all their stores. So whenever their food revenue goes down, they can always make up for it with their gift shop sales because they have high profit gift items. So they buy them really cheap and they sell them for pretty high. And it's like when everybody else is doing poor, Cracker Barrel is still coming out consistently making up for those losses, and they're always doing a really good job. And you can see in 2016 and 2017, they were leading the pack on the return on assets. Return on equity. So Cake is doing awesome here. Cracker Barrel is doing the best out of everybody, and that return on equity is due to the retail store in the front of it, and that's really differentiating them. Cracker Barrel also, like, they have this, people when they make restaurants, they really try to focus on the experience, the ambiance, and Cracker Barrel takes it to a whole nother level. They have a whole bunch of different retro signs. They have tricycles hanging from the ceiling, that are from like the 1920s, and they have old cigarette ads like Lucky Strikes and stuff like that. So it really creates this ambiance that none of them really can capture. And they do their own things individually. Like, for example, Darden owns Olive Garden, and they have their own, ambiance, their own feel of the restaurant. But Cracker Barrel is just in a league of their own. Tax burden. So, Darden they have some very interesting tax burdens compared to everybody else. Everybody else seems to be pretty consistent between 60 and 70, seems to be about the industry average. But these guys are consistently chugging up at 150, 163, 404, and then they come back down to 83, 705. So my guess is they probably had some net operating loss carry forwards that really inflated that number. Interest burden. Once again, I don't think Bloomberg pulled the right numbers for BJ Restaurants and Texas Roadhouse, but Cake doesn't seem to pay very much in interest. And then Darden, they have a lot of loans, and they seem to be paying a good bit. Looks like they paid them off in 2016 and 2017. Their interest burden came up to 93. So everybody seems to have around the same interest, except for Darden for those first 4 years. EBIT margin. So, and the reason why Cracker Barrel is leading on the EBIT margin is because of retail sales, and that's why they're outperforming everybody. That's why the numbers are a lot higher. Cheesecake Factory did really good in 2013, but consistently overall, Cracker Barrel has been kicking their butts. PE ratio. So all these guys have really, really high PE ratios. The interesting thing is, even though Cracker Barrel has been outperforming all these guys consistently, their PE ratio is actually lower than everybody else. And that's really interesting to me, that they have these strong financials and they're just consistently chugging out dividends, returns, and I guess they're able to price them a lot more easily and more effectively than they can for Darden or Cheesecake Factory or BJ Restaurants. But the highest one we have here is BJ in 2014 at 46, and then the lowest one is Cracker Barrel in 2014. Market to book. So Cracker Barrel has about 5. It goes from 5, almost 5 in 2013, 2014, up to 6, almost 7 in 2015, stays at 7 right around 2017. So this is, some consistent numbers that these guys are worth 6 times what their equity is saying. And it shows that in the industry, these guys, they'll have around 2, 3, 4 times what their book is worth, but Cracker Barrel is, sitting at 7 times, which is awesome. And the reason why that they might be so high is because 80% of the investors that are in Cracker Barrel are institutional investors. So that's probably why that they're sitting at almost 7 times what their equity is worth. Economic value added. So we have a couple losses sprinkled out through here. 2013, BJRI had minus 15 million. Darden lost 214 million, and DRI. They didn't literally lose 214 million, but in terms of economic opportunity cost. But Cracker Barrel consistently has been performing better than what shareholders expected. We have 52, 78, 98, 142, 156. They're doing awesome. Darden definitely made up for those losses in 2014 with the earnings, the opportunity cost in 2015, 2016, 2017, and they've been leading the pack in terms of doing better than what shareholders expected. But overall, the best companies that I chose out of each one was for construction. I chose MTZ because of their strong, consistent earnings compared to everybody else. And far as the newspaper industry goes, New York Times, because they've just been consistent. And out of the restaurants, Cracker Barrel kicks some butt, and they're going to continue to kick butt. And I don't think they're going anywhere anytime soon. And they're going to continue to innovate and implement technology to provide better service, and they're going to outperform other restaurants in the industry. So I chose to write my sell side report on Cracker Barrel, and I think it's a very good company, and I think they're going to grow a lot over time, and they're worth investing in. Thank you for listening to my project.